US stock indexes are floating along on all-time highs, and we're halfway through the summer holidays. But there's lots to talk about this morning. Francois Savary, hello.
Hello, Mark.
So a number of things we need to talk about. Obviously, the EU-US trade deal. There's a busy week ahead for economic numbers. There's the Federal Reserve on Wednesday, and we're halfway through the US earnings season. Let's go to the EU-US trade deal. I was just watching French television, and all French commentators hate this deal. What are your thoughts on it?
They can hate it, but at the end of the day, it's better than no deal because at the end of the day, if you had a no deal by August the 1st, it would have meant that European Union would have faced a 30% tariff. So at the end of the day, what you have is Mr. Trump able to set the rule for the negotiation and to get what he wanted to have, which is a 15% tariff for European goods entering into the US. So you can say that, okay, it's a bad deal. Yes, obviously there were some concessions that were made to the US, but it's better to have one deal than no deal. And I think that it is the position that is the right position. I think that this morning, and when you look at the future on the European stock, clearly it is going to have a positive impact because the market was fearing. If you think about 3 weeks ago, they were fearing about the possibility that 30% tariff could have been imposed on European goods. So it's a relief. Is it a relief rally? Is it something that will last? I think that it will depend on different things. It will depend on the attitude of the European Central Bank, which last week decided not to touch the interest rate. Does it mean that the interest rate cycle cut is over? It will depend on the economic development in Europe. And what was very interesting last week is the fact that the PMI numbers came out in Europe better than expected and seem to show that there is a turnaround in economic activity. So I think that European equities still have the ability to move higher. Does it mean that the US equity market is over and that there could be a rally in European stock without a continuing rally on the US stocks? I don't think so. I think that the US market remains the leader market. Does it mean that you can have an outperformance of a European stock compared to the US? I think that it's still possible for the coming months.
Is this going to have an effect on the US dollar?
The US dollar is under pressure. You know my position. My position is still that the euro is going to appreciate against the US dollar. I don't think that the deal is going to impact that. It's more, and we saw it clearly last week when you had again all those pressure by the Trump administration on Jerome Powell. This is related to the ability of the Federal Reserve to maintain its independence, and I think that is something that is going to continue to weigh on the US dollar because over the weekend there were new declarations about the administration about the need for Powell to cut rates this week. And also don't forget that the European economy, as I said, is showing sign that there is some kind of turnaround, moving in a more positive position in the coming quarter. In the US, whatever Mr. Trump says, you have a slowdown in economic activity. And this is the reason why this week is very important for market investors. They are going to watch in detail the publication of the number, especially the GDP number that is going to be published. And because you don't want to only look at the general number, which should be around 2%, which means that it's much better than the first quarter, which was distorted by some significant impact of imports. But you want to see what is happening on consumption, what is happening on investment. And I think this is something that is very important. And I think that the difference of economic activity at the margin is moving towards Europe. And that's the reason why I defend that we are going to see the 120 by the end of the year.
The market is still waiting for a catch up on the first quarter's GDP numbers, which were distorted by imports. Are you expecting a bigger move than only 2% for the second quarter?
When you look at the federal calculation, the Federal Atlanta Fed calculation, it's around 2.4. I don't think that you should expect something that is significantly higher than that. And as I said, what I will be very interested in is the detail. What is happening with consumption? What is happening with investment in the US economy?
What about the non-farm payrolls? What are you expecting from those kind of numbers?
When you look at the consensus is expecting something like about 100,000. It means that there is a deceleration in job creation in the US, but not a significant one. What I will look is, okay, Do we have job creation in the private sectors? Are the job creation in the private sector really outperforming what the market expects? Or are we going to see the same kind of development as last month, which was the job creation was mainly in government jobs and not so much into the private industry. So this would be an indicator of the real strengths of the US economy. And I will look at the average early earnings because one of the arguments of many people want to see the Fed to act this week, which, by the way, I think it is not going to do, is the fact that there is a slowdown in average early earnings. I want to see if it's really going to be the case on Friday.
Federal Reserve is making its interest rates announcement on Wednesday. I know what you're going to say, but should we be expecting anything on Wednesday?
I don't think so. I think that what is going to be very interesting, it's not so much on in the interest rates. I think that the chance that they cut rates is very limited, close to zero. What is going to be very interesting is if there is dissent among the Fed members. We know that there was some dissent at the last meeting. Is it going to increase? Do you have more divide between members of the Fed? How Mr. Powell is going to be able, if there is big division among the Fed members, how is it going to give a common message when it comes to his declaration to the press? I think that is what I'm going to take a close look at.
Earnings season now. We've had 2 weeks of earnings season. First of all, let's come to what's already happened. Are there any remarks on the earnings you've seen so far?
Good numbers in the US when you look at the result. It's about 80% beat on the expectation, which had been lowered in the course of the last few weeks. So in the US, it's quite good. In Europe, it's different matters. It's more mushy. And, I think that you had some disappointment, but you had some sign that things could improve. With regard to that, you could look at the LVMH numbers. They were not particularly good. The sales decrease was lower than expected. So it seems that there is a stabilization in the sector that is looming. So better in the US than in Europe.
There's 4 of the Magnificent Seven reporting. What are you expecting from that, if anything?
What I will expect is that they continue to defend the idea that they are going to see all the positive effect of all the investment they made and they are continuing to make, that they are showing sign that it's going into the economy. I would like to see that. And, for example, it was very interesting last week because you had alphabet numbers coming. They were quite good. But what was interesting is that they are accelerating their investment and they announced that they would accelerate the investment for 2025 by 10 billion US dollar, not a small number, and that they would continue in 2026. So we are still looking with the Magnificent Seven with this idea, okay, it's good to invest, but do you see sign that there is a diffusion to the rest of the economy of the artificial intelligence? So that's what I'm going to take a very close look at. But it's not only the Magnificent Seven that are going to publish this week. You have a lot of publication this week in terms of companies reporting is very important. You had significant companies like Visa, like Procter and Gamble's going to produce their number in the US. You will have significant companies giving their number in Europe. You will have Hermes, you will have Kering, you will have Airbus. In Switzerland, you will have Sika, you will have Holcim, you will have UBS. So this week is very important, not so much only for the Magnificent Seven, but also to see how the rest of the economy is behaving.
What does the earnings numbers say to you about current multiples on US stock indexes?
When you look at the numbers, the S&P 500 12 months forward PE is around 24. X Magnificent 7 is 22. It tells me that this is expensive. It tells me that you are much above average level historical. And so it tells me that you still depend very much on the interest rate developments in the course of the coming months to justify such a level of PEs on the US market. This is the reason why there is so much pressure now on the Fed to lower interest rates. Because if there is no lowering of interest rates by the end of the year, it's going to be very difficult for the US equity market to sustain such a high level of multiple. If, as I expect, the interest rates are going to be cut twice by the end of the year, then you can live with those numbers. Can they expand significantly from current level? I don't think so.
Francois, thank you very much. I think that's all we've got time for. I look forward to speaking to you next Monday.
Okay, you have a good week.
You too. Bye-bye.
Bye-bye.